Okay, welcome everyone. Serge Berger here. Let's do a quick audio and visual check. If you guys can hear me and you can see the screen, if you could quickly type in a plus or a yes or something like that, that would be good. You should be able to see a screen here that says something like swing trading stocks and a couple of points. Good. I'm doing well, guys. Thank you for asking. How are you guys doing? Everyone doing well? Yeah. Did everyone have a good January? How did it work out? I think January is always one of the most difficult months in my opinion, to trade. So let's start. And what I want to talk about today, and what the topic is today, is swing trading. So we've talked about it in a couple of webinars already. But what we need to do now is take it another step further. And what we are going to focus on today is this whole notion of patience. So that's number one. I will discuss this in just a minute. And then we need to understand, in order to be profitable swing traders, we also need to, again, maybe quickly go through the definition. I think that's very important to kind of maybe just give us a quick reminder of what that means. And number two, we are going to be looking at economic data and corporate earnings. So we've got Ahmed. He's a new here for the first time today. So welcome to you. Great to have you here. We are going to discuss, Ahmed, for you, if you've never been here before, talk about swing trading, which is basically holding stocks or trading stocks for the holding period of a few days to maybe a few weeks, sometimes a few months. Okay, that's going to be the topic today. I would encourage everyone to watch the first webinars that we've done. This is, I think, probably about number 10 or so that we've done. So please make sure you watch the other ones. Yeah, so that's going to be the two things I want to focus on today: patience and understanding what to do with economic data and corporate earnings when it comes to trading. We have Apple to talk about today. Apple stock is rallying very strongly today, i.e. it's going up very strongly. Okay, this here's the chart of Apple today. I'm going to make this a daily chart, just 1 minute. And so those are the two things we want to talk about today. Now, before we even talk about that, what I would like to first go through is this whole notion of seasonality. Okay, and we have touched on it a little bit already over the past 2 months now. I think it's almost been that we've done these webinars, month and a half maybe. And seasonality is important. So when we talk about seasonality, we talk about, when is the market most likely to go up, when is it most likely to go down, and when is it most likely to be maybe a little bit more volatile, and maybe, sometimes it's just flat out confusing. So specifically, of course, in this webinar series, we are specifically focused on the U.S. stock markets, the American stock market, but you can also apply this very much the same to the European stock market, and probably also to some Asian stock markets. Okay, so I think it doesn't really matter which market you focus on. My focus is U.S. stock. That's specifically what Roboforex asked me to talk about. That's also my specialty. So I'll be focusing on that, but you can apply the same thing. Now, I will tell you that, to me, the easiest time to to trade stocks is usually from October to early December. Okay, so I'm going to quickly go and make a second page here. Okay, let's do this. And I'm going to write it down for you. Okay, so for me personally, the stock market tends to rally go up, okay, from October until the following April. That's your best time of the year for the stock market, okay, the US stock market. So usually from October until April, maybe into May, okay, so I'm going to do /May, the market tends to go up. It gets more tricky from May until, let's call it early or mid-October. It's trickier, okay, i.e. more difficult. All right. So this is important because if we know this basic statistic, and of course this statistic isn't true every single year, but it's true a lot. If we know this basic statistic, and let's say you were very, very negative in the market, you are kind of fighting the odds from about October until May. Now, of course, within this time period, you are going to get periods when the market will be going down as well. Of course, you know, I mean, just look at 1 year ago, the stock market dropped very hard in January and February. Okay, but on average, these are facts. Okay, the stock market tends to act quite favorably from October until May. Now, from May until October, it's more difficult, but of course it doesn't just go down all the way, you know, in a straight line. Nothing ever goes in a straight line. The stock market, you know, always goes up and down and up and down and up and down and down and up and that kind of thing, right? Now, talking about January and February, I find particularly January is a very tricky month, and I don't really know specifically why, but I can tell you empirically from my experience of nearly 20 years of doing this that January is, you know, can be a very strong up month. It can be a very strong down month, like it was last year. But it can also be just very boring and very, very choppy because people are trying to I don't know if they're trying to get back to work after here in the US we have you know, the holidays, of course, Christmas, stuff like that at the end of December. So I don't really know why, but I find January to be quite difficult. February is a little bit easier, and then usually have March and April that are you know, even better. Okay, so I just want to give you guys a little bit of statistics on that. I think this is very important. Now, we do, of course, have earnings season as well. That's happening right now. We will talk about that here in a little bit. But first, let's go through and let's talk about patience. And I've touched on this already a little bit over the past number of webinars we've done together. But I think patience is something that cannot be understated. So let me go over to the Roboforex chart, and let me try to show you what I mean by patience. Okay, so let's look at the S&P 500. We could look at other sectors or other indices or other stocks or whatever as well. It doesn't matter. But the notion of patience is very visible a lot of times. So let's just look at this. I'm going to get rid of some of these red boxes that I drew, which kind of show the same thing that I was about to tell you. But you can pretty much ignore these moving averages here. I have a 200-day moving average. I have a 100-day moving average in blue, and I have a 50-day moving average in yellow. Okay, very, very basic stuff. And again, for Ahmed and maybe this is definitely something that is very basic, so you should be able to follow along. If you have questions, just ask. Okay. But when I talk about patience in the S&P 500, you can see that sometimes the market is very boring and it doesn't really do anything, right? So essentially, what we have here is periods in the S&P 500 where we rally, we go up, and then we consolidate, then we rally, and then we consolidate, and then we rally, and then we consolidate. So a lot of times the market doesn't do anything. So like, let's focus, for example, right now. All right. So let me get rid of this, and let me draw a very simple box so you can see what I'm talking about. Okay. So if we look at the S&P 500 for the past month and a half, so let's call that the past 6 weeks, you can see that we had a very strong lift or a very strong rally to the upside. Okay, that's what we call a rally. And what we then had is we had the market go sideways, right? And so really, if you look at just the S&P 500, it hasn't done much at all over the past few weeks. So this is when I talk about this notion of patience. The biggest mistake that I see, and this maybe goes for someone like Ahmed who's new to this business, a lot of people, and I really mean like 95% of people that are new to trading stocks and to trading anything for that matter, are extremely impatient. And it's not because they may not be impatient people, but it's because they have an unrealistic expectation or unrealistic view of how much it takes to make money in the stock market. Okay, so this is very important. And the fact is that the stock market goes sideways, okay, like this, about 80% of the time. And you can see this here empirically. You can see if we peel back the chart a little bit, we have rallies, and then the market just kind of yes, it goes a little bit down, a little bit up, but really, it's largely speaking, it went sideways in this period, right? And then it goes up, and then it goes sideways, and then it goes up, and then it goes sideways. So if you look at all this, you can tell that the stock market goes sideways a lot of the time, which is why patience is so important. Okay, so let me quickly go back to this here. And what I wrote here is very important. Patience, let the market come to you. Does anyone know what that means? Do you know what that means, letting the market come to you? If you haven't, but what it means, I'll tell you in the meantime. It means the market to do something where you become at price levels where you would be interested to do something. Okay, this is a big difference between what most people do, which is most people look at a stock, and let's say a stock goes up, like Apple today. We will look at Apple here shortly. and then they just buy it because it just went up. There's on no other basis than that. If that's what you're doing, what you're doing is you're chasing the stock market higher, or it could be the forex market. It doesn't it doesn't matter which market. It's the same issue, and you don't want to do that because what that does over time, it's going to deplete your account very quickly. So instead, what you want to wait for is for the market to come back to you. Okay, so come to you. So let's just look at the S&P 500 here, and we can look at many examples, but let's just look at one specific example here, and then I want to look at Apple so you can see how this works in shares of Apple as well. Okay, so first let me just get rid of some of this stuff over here. There's a lot of things here that I drew. Okay, so let's get rid of this as well, and let's draw a very simple line, okay? So let's assume we are looking at this period here, okay? Or we could even, let's just look at this here, hold on. Let's look at this period. Maybe like this. Okay. So what we had here is market bottomed out in January and February of last year, and then it rallied very, very, very strongly. Well, when the market does something like this, you usually don't want to buy it higher. You want to wait for the market to come back down to a level where you will find. And in the case of the S&P 500, like for me personally last year, there was a lot of support here around the 200-day moving average. That's the red line that you can see here. Okay. So that's what we call letting the market come to you. Let me give you a better example. I think we can give you a better example. So let's look at shares of Apple. And by the way, this is the Roboforex platform. So what we are doing here is we are looking at the Roboforex platform. All I have to do is type in either the name of the company or the ticker symbol. And for Apple, the ticker symbol is simply AAPL. So we click on that. And now we get to the chart of Apple. Let me get rid of some of these red boxes that I drew. I drew this, I think, at the last webinar. All right. And so let's look at what's going on here. So to me, and I just made a public video on this. If you go to my website, thesteadytrader.com, you can go check it out there. Let me just quickly type that in. The address is. All right, this is my website, and what I did there, I just made a public video, a free video, on Apple. Okay, so I would urge you to go look at that, watch the video, go to thesteadytrader.com, and it's the first log or video on there. But if we look at Apple right now, you can see that the stock has rallied or has gone up very strongly over, let's call it the past 2-3 months. So today the stock is up very strongly, about, I guess, what, 5% or so. And I have to ask yourself, are you willing to buy this stock here after it has already gone up so strongly? Well, I would argue that the answer is no, and here's why. Again, chasing stocks up or down is usually a low probability strategy, because what's going to happen is ultimately a stock is once again going to consolidate. And what does consolidate mean? It means it's going to pause, to stop going up for a little bit. Maybe it's even going to come back down. Okay. So let's look at right now. So right now you can see the stock in 2015, Apple in 2015, made what we consider a triple top. So it had a top here, another one here. I guess we could consider this one another one as well, and then again here. So there's lots of technical resistance up around this area of 100 and 34, $135. And so let me see here. Here we go. So that's basically this area here, right? That's roughly where resistance is. Well, Apple stock right now is trading, around $128. That's about what, $6 away from this big resistance area up here. So now you have to ask yourself, do you think that Apple is going to be able to rally past this area of resistance, the previous all-time highs for the stock, on a sustainable basis, or is it most likely that it's going to take some sort of a break and then maybe consolidate a little bit sideways or lower? Well, the upside here is probably limited in the near term to just a few points. Like I said, maybe 5-6 points. So if that's the case, then we probably don't really need to buy the stock here. It's probably what I would label it as is overbought in the near term. Now, if you are a day trader, someone who only looks at the market within the day, which I am not a big advocate of, although I will talk about this. I think the next 2 webinars are going to be on that as well, and I will show you some things that work in that. But if you are looking at the market through, for trades that last a few days, a few weeks, maybe a few months, it's probably not a great idea to buy Apple stock right now. So you have on the upside about 5-6 points of upside. On the downside, it's probably about the same. You probably have downside, immediate term downside to, maybe a little bit more. Maybe you have 8 points of downside, down to like 120, let's say. It's basically just the up gap from today, right? So I think here you can see a little better. On the upside, maybe 5-6 points, and the downside, maybe a little bit more, a couple points more. So again, you can buy the stock here, but you just have to understand that you're probably going to run into resistance up here, somewhere up here, because the stock has already gone up so sharply over the past few months. Does that make sense? I would love to see if that makes sense to you guys, because it's important for me before we move forward that, okay, perfect. Excellent. So this now, pretty much comes right down to patience. So we talked about patience, and we talked about the importance of letting the stock come to you, and as opposed to you chasing it higher. So for me personally, right now, I'm not doing anything in this stock. I'm not involved at all because I personally don't like to hold stocks through earnings reports. Of course, Apple just reported earnings last night, last night. And so to me, what I'm looking for is I would be interested in buying Apple again, maybe somewhere close to $220. And here's another thing to look at. So, let's talk a little bit. Let's do a little technical analysis. So to me, if I draw the lines for Apple, I would draw them something like this. Okay. So to me, you can see that Apple has basically gone up and down and up and down and up and down and up, all in this channel. That's these 2 parallel lines, right? You can see that. These 2 parallel lines. Well, we are now once again getting to the upper end of that range. And to me, from a simple reward to risk perspective, it doesn't look very favorable anymore. So I would be much more interested in maybe buying Apple closer to, the lower end of this range, and I suspect that the lower end of this range is probably going to be somewhere around $120 pretty soon. Like, even if Apple were to come down right now, $120 is in the lower end of this range, right? Okay, so that's why I think that something like Apple right now is not something you want to buy. You can give it time. But again, most people look at this and they want to get in on the action. They want to see if the stock can go back up to $134. And again, that is a strategy, but I do think it's a lower probability strategy than if you were to wait more patiently for the stock to come to you. So if we now go back to this slide here, that's exactly what I'm talking about. I'm talking about letting the market come to you. And psychologically, this is, I would argue, impossible to understate the importance of. I think that this is the number one big difference that between people that make money in the stock market and people who do not make money in the stock market. So let's talk about this in one more example. I want to show you guys another example. Let's look at another stock. Is there a specific stock that you want to look at? Let's maybe look at a specific stock. Ahmed, I don't know if you already have a stock in mind that you like to look at. If you have one stock someone wants to look at, we can look at that right now. So if you have a suggestion, let me know. Otherwise, what I will do is I will show you shares of Facebook. Okay. So Facebook is a really, really good example as well of, from a swing trading perspective, where patience was really, really important. You can see that the stock had a very, very nice move to the upside over the past few years. But every time the stock got to the upper end of this, what we call channel, see, every time we get to the upper end, that's how we managed to actually draw a channel. Every time the stock then was not a good buy, because ultimately it would come back down at the very least to the middle part of that range. And that's exactly what I'm showing you in Apple right now, because Apple is basically now trading like up here in its range. So for Facebook, and I actively look at Facebook from a trading perspective, and I didn't do anything this whole period this summer. There were some trades last summer to do, but for the most part, we had to be patient because the market, like I said before, Facebook didn't. Yes, it went a little bit higher. You can see over time, over this period, it went a little bit higher, but really it didn't do a whole lot. So when the market is at the upper end of its range, the odds of it going lower to the lower end of the range, or at least to the middle part of the range, are very high. Okay, and so this also just speaks to this whole point of patience, which is to say that you want to let the market come to you. So down here, when the market came back down here for Facebook, it was, in my opinion, finally a time again to buy that stock for the first time, probably since over here at this point here, because here it was overbought, right? So yeah, we will look at some of those stocks, ABC, that you're looking at. He wants to look at some stocks that are reporting earnings next week. But just quickly, just a couple more minutes on Facebook. This whole concept of patience and its ultimate result, not only on your bottom line, not only on your profits, but also, maybe more importantly, psychologically, it cannot be understated. So it's much healthier to wait and be patient, because the market is always going to be there. There's always going to be opportunities for you to be able to take advantage of. Okay, so that's a really, really big, important thing to understand. Okay, so now, by the way, Facebook is looking to report earnings, I believe, either today or tomorrow, I think. Either today or tomorrow. And so it's the same thing here. So, Facebook is now looking to, maybe if it gets to the upper end of this range, maybe if the stock goes up towards, $140 or near there, then in my opinion, this would be once again a stock that you don't want to buy up there. You would want to be more of a seller, excuse me, than a buyer of the stock up there. All right. So again, this is this whole notion of patience that I think is unbelievably important. All right. So let's quickly go back to Apple for 1 minute. And just once again reiterate this. So you can see that Apple is, not only is it now trading at the upper end of this range, right? But it's also just within a few points of the previous all-time highs, which were, in this case, around $135 or something like that. So again, patience is important. So you want to wait for, in the case of Apple, you don't really have, you don't really have any reason to buy it up here. It's just ultimately it's not a very high probability bet. Okay. So, that really also gets us around, talking about corporate earnings, which is really kind of what we're talking about right now. So the best way to explain this to you is to look at shares of Google. Okay. And you can see here it's the same concept. All right. We had a stock that was, Google was basically going sideways for a long time here for in the past. Then it went higher, and then it once again basically just went sideways. It had some nice rallies in here, and that you could have definitely participated in, but largely speaking, the stock went sideways. And now it once again became very overbought. Well, this stock, and let me get rid of some of these red boxes here to make things a little bit simpler. Okay, so let's look at this more closely. So Google reported earnings, the company is called Alphabet now, so we have to be politically correct and call it Alphabet. But Google stock had earnings last week. They reported earnings. And you can see that the stock tried to break higher and rally, but it couldn't remain up there, right? You can see that very, very quickly the buyers, they no longer had any energy, right? This, people, what happened is people bought the stock before earnings, right? And then once earnings came out, there was just no more buyers left. All right. So to me, what's most important about earnings is to wait for the market to tell us what to do, and for a specific stock to come to us. So what I actually did last week after earnings, I did an options trade in Alphabet, and specifically what we did is we sold out of the money call spreads. So that's a bit of an advanced topic and probably not something to talk about right now, but basically, there was a lot of opportunity to sell the stock after earnings, because you can see this is the day when the company reported earnings, so the market tried to rally higher, and there were no more buyers left, so the market had to go down. The problem was that the stock had already rallied very strongly into earnings, like before the earnings announcement. And that's to me, it was really the troubling sign here, that the market just, had rallied into earnings. So that's also why, if we look at Apple now again, it's a very similar story. Now, Apple didn't rally as strongly as Google did into earnings, but here too, the stock had been going higher steadily into the earnings report. So then now when you see a big move like this after earnings, it's just not, very interesting to buy it up at these types of levels. Okay. So that's really the main issue here at hand. All right. Now let's look at some trades that you wanted to look at. ABC wanted to look at a couple of trades or potential stocks. So these are all stocks that are reporting earnings next week. So this actually fits very well into today's topic. So again, just let me just be clear that I personally, for me, I do not like to make bets on stocks before they report earnings, because the outcome is what we call binary. It can either go up or down or sideways. It's just the immediate term reaction is in my opinion is impossible to guess consistently, right? So let me just have a quick look here on another window when, for example, General Motors is scheduled to report earnings next week. Just having a quick look. All right, so GM is scheduled to report on the 7th of February, which I believe is next Tuesday. All right, so let's have a look at where GM is, and this is actually a pretty good risk management exercise. So this is it. So we're looking at General Motors. First, let's look at it from a long-term perspective so we can kind of, really get a nice idea of what the stock would look like. All right, so let me zoom in. So you can see basically General Motors had a very nice breakout rally here in, I guess, last November, December. And it broke past this resistance. So what it started doing, it started making a higher high versus the series of lower highs, and now it's making a higher high. Okay. So now what the stock is doing is basically consolidating. You can see that once the stock started breaking out past resistance, it's now basically consolidating. So that's point number one. That's what I would be looking at here for GM. So now if GM after earnings can overcome, let's say, this area here, let me just highlight this a little bit more. Say this area, right, which is around almost $38. If the stock can go above $38 or so and hold there, then I think the stock could start going much higher. Maybe it goes back to these highs here, which is about $42 or so, I think. If the stock starts breaking lower, maybe you can play it to the downside. Although I think the stock has lots of support here. You can see these long-term moving averages, the 200-week moving average, the 100-week moving average, and the 50-week moving average. They're all coming in here for potential support. So if the stock were to drop down here, you probably don't want to short it unless they have catastrophic news and the stock just totally falls apart. So to me, this is how I would look at it. Now let's look at it on the daily chart. I'm going to go into a one-day chart. And so now what I'm doing is each one of these candlesticks, each one is 1 day, right? So you can see now we are basically in the middle of this range that I just drew. So really we're nowhere. There is a very low probability right now of making a successful trade in General Motors before earnings, especially because they have earnings coming up, I guess next Tuesday we said, right? So that's a little bit less than 1 week away. Now, if you're a very near-term trader, I guess you could try to make a bet whether General Motors is once again going to go down here to the lower end of the range, which is closer to, $35. But again, the stock's reporting earnings next Tuesday, so it's probably not a great idea to try and do much before then. Okay. Yeah. Perfect. Okay. So now let's talk about Disney. Okay, just another stock that is being suggested here, and I think that's always an interesting stock. A lot of people know about this stock, and it actually doesn't look all that much different. It's just that it too is probably overbought. So let's have a look at this stock and see what it looks like. Well, we can probably draw some very simple lines like this. I'm going to ignore this here because you can see it was quickly rejected, this price action. And from this angle as well, you can see that all the moving averages, in this case, we're looking at the 50-day. Okay, now we're looking at a daily chart. The 50-day, the 200-day, and the 100-day, they are all curling to the upside. All right, so this is pretty good, which, to me means there's probably going to be a lot of support here. But let's look at it. Let's look at it like this. Now, let's also understand that this stock basically trades in like this kind of a range. So this is essentially your range that we're talking about, like this. Now here too, you can see that Disney, right now it's in the middle of its range, but the upper end of the range is not very far away, and it's a very steep range. So here too, if this stock were to rally after earnings, I think you could have a really good opportunity to sell the stock, maybe sell the stock short. Maybe even if you play options, you could buy some puts or put spreads, or sell out of the money call spreads. And these are all various opportunities, various different things that you can do. Okay, so that's just to give you an idea. So to sort of recap this, you can see by having done this sort of swing trading analysis, going through the long-term chart, looking at the more near-term chart, and looking at what the odds might be for a trade after earnings, we come up with this, and we can see that it's probably not a great idea to, if the stock rallies after earnings, to chase it higher. Very much like what we talked about in Google. Okay, let's go back to Google for a minute. That's here. Same thing. We're gonna rally, exhausted, and then reverse back down. In Apple, we are still witnessing the rally unfold right now. It's very early on still. We, or only about halfway through the first trading day. But I think the odds of buying it here are just very low. Let's quickly, by the way, have a look and check at the market just to kind of see what's going on, if there's anything interesting. So just take a 1-minute break here to look at the market. So we're looking at the S&P 500. Let's look at the intraday. So we're looking at a 5-minute chart. That's just today. Well, it's not just today, but this is just today, this bit here. You can see that the market is basically on hold. So in about in less than 2 hours from now, we are going to get the Federal Reserve statement, and that's actually the second point I wanted to talk about today. Okay, so this is a pretty good transition. The Federal Reserve, so we call it the Fed, is basically about to announce what their latest comments are on interest rates, whether they're going to raise them more or keep them lower or whatever, right? Just their general assessment. Well, I remember before on this page we talked about economic data and corporate earnings. Well, so far we've spoken a lot about corporate earnings and maybe what to do or what not to do from a swing trading perspective around earnings. But let's talk a little bit about economic data. And there is very little that's more important than, you know, the Federal Reserve's interest rate assessment. Now, technically speaking, it's not really an economic data point. I guess it is, but it's not really. It's, you know, it's between, so the two most important ones, at least in my opinion, or at least the one that the market seems to focus most around is jobs reports. So, you know, what's the job market look like? Number one, and number two is and it is not necessarily in this order, but a second one of very big importance, of course, is the interest rate announcements. Okay, so like today, what's happening in less than 2 hours from right now, from when we're recording this. So those are two very big things, and we want to be aware of when these things are happening, because you don't really want to be getting into big trades before then if they are pure trades. So like right now, you know, that's the reason I showed you the S&P 500. You can see what's happening. The market is now going to slow down a lot. For the next 2 hours, this market is going to get probably very boring unless something totally different happens. But you can see we had a little bit of price action this morning, a little selling, right? But now really we're just kind of not going anywhere. We're just waiting. We're wait and see mode. So for the next 2 hours, I would be very surprised if this market makes a huge move until this event happens. So when we talk about economic data points, particularly the Fed meetings, there are specific things we need to watch. So the most important thing to watch, of course, is bond prices. You can look at ETFs, exchange traded funds like the TLT. This represents bond prices. Okay. And I think very important is to look at banking stocks. So for example, we could look at a banking stock like that of Bank of America, right? So this is maybe a good trade idea to look at right now. Okay. So, oops, what did I do here? Oh, like this. Okay. So you can see that Bank of America for the past 6 weeks or so really hasn't done anything. It's mostly just gone sideways. And the way we look at this is very simply like this. And this once again, remember what I said before about the stock market mostly going sideways most of the time is exactly what's happening here. So maybe today, once the announcement is finished and people have had time to react to it, maybe we will see the price of Bank of America either go up or down out of this channel. So, so that's what we're looking at. And yeah, so Aquan is exactly. So these are all financial stocks. So it's not surprising that they are trading very similarly, right? That's just a fact. So, you know, remember one of the things that we talked about early on in this webinar series is the fact that well, two facts. Number one is that stocks mostly tend to go sideways. So 80% of the time, the stock market basically does nothing. Just goes sideways. And again, it's, you know, sometimes not something people want to hear, but it's a fact, and we have to respect that. That's number one. And number two is the fact that the stock market is highly correlated, very highly correlated. Do you guys know what that means? So when something is highly correlated, it means that it, you know, does something very similar to something else. So for example, in the stock market, most stocks go up or down together. You know, if the stock market goes up very strongly, then most stocks, and like 80% of them, go higher. It's the same analysis here in the financial sector, right? So I give you the example of Bank of America. ABC showed us Aquan Financial, which is a financial sector component. So it's not surprising that these two stocks would do the same thing, right? So we can even look at an exchange traded fund that represents the S&P 500 financial sector. And here too, you can see we are basically just going sideways, right? So these are, so banking stocks are very, very important to watch during these types of announcements. So over the next, at this point, over the next hour and 45 minutes, there's probably nothing to do. But once we get a statement out of the Fed, and maybe we get something worth doing. So I am, so and in full disclosure, I am very specifically watching things like Bank of America. If we see a break, above 23 or so, then I think that could be interesting on the buy side. If we break below here, maybe we have to start looking at this from the short side. So to me, I don't have any positions on, but that's basically what we're looking at here. So that's that. And by the way, speaking of consolidation and patience, there is few examples out there that are better than what we are seeing in the biotechnology sector right now. So these are biotechnology stocks, and over the past they have been very strong performers. Look at this is an exchange traded fund. So it's almost like an index for those of you who don't know. That represents basically biotechnology stocks, and you can see they've had very strong move to the upside over the years. But since this point in time here, okay, you can see that for the most part, except for a few failed attempts, this part of the market is basically dormant, i.e. very, very quiet, and really mostly just going sideways. Okay. Now, obviously, excuse me, there have been some down moves, some up moves, some down moves, and all that stuff. But we are doing all of this price action within this big range. So yesterday, we had what I would consider a pretty good move to the upside in these biotechnology stocks. But you can see we're still just stuck in the range. We haven't really broken higher. So I'm watching these biotechnology stocks very closely to see if we might be able to ultimately get some sort of a break to the upside and a resolution higher. So that's what I'm looking for here. Again, it hasn't happened yet, which is exactly the topic of today, which was the patience for swing trading. So patience, letting the market come to you. Let the market come to you. That's really the main thing I want to talk about today. So if we can get, in me personally, I would be interested in buying IBB if it breaks above here for an intermediate term trade. If we see a little bit more upside here, I may even be interested in a small trade to the upside for the near term. So again, the point is to look at the market and highlight areas of interest where you would be a buyer or a seller. You don't want to be forced to become a buyer or a seller when the market's already doing something. You want it to be at predetermined levels that interest you. And what happens with people is that they see a big move, like they see in Apple today. Let's look at Apple one more time. They see a big move in Apple today, and they get very excited, right? And I can understand why they would be excited. This looks pretty cool. But the problem is that the move has now probably already happened. You want to be patient. You want to wait for this market to come to you, and by doing so, you are going to dramatically put the odds in your favor. So for Apple, for me personally, I'm interested to maybe play it on the short side if we get a bearish reversal. But on the long side, from a buying perspective, I would be more interested in buying it somewhere closer to $120. So anyway, guys, are there any last questions? Does this all make sense? Are we good to reconvene on Friday, or do we have any more questions for the meantime? I'm happy to take any more questions if you have anything. But if we're all good, then I want to thank you for attending today. Hope you guys learned something, and I look forward to seeing you on Friday. Take care, and I'll talk to you soon.